How real estate investors secretly control housing prices in America. Across the vast landscape of the American economy, a silent transformation has taken place within the walls of the one place people consider a sanctuary, their homes. While the average citizen looks at a rising rent check or a skyrocketing home valuation and sees the simple result of a local market, the reality is far more complex and orchestrated. Behind the curtain of neighborhood listings and open houses lies a sophisticated, interconnected architecture of high-frequency algorithms, global financial derivatives, and decades of government-engineered leverage. This structure does not merely respond to housing prices, it dictates them. In the quiet hours of the morning, thousands of property managers across the United States do not consult their local competition or their own vacancies to set prices. Instead, they receive a single, unified instruction from a centralized dashboard. This digital command, powered by non-public data and predictive modeling, effectively eliminates the natural downward pressure of a competitive market. The system is no longer a collection of individual owners, but a synchronized machine that prioritizes revenue management over the human need for shelter. Something about the mechanics of the housing market feels fundamentally broken to the ordinary observer, but very few understand the specific gears that have been turned to ensure prices only move in one direction. The question that must be answered is, who actually controls the price of a roof in America? Section 1. The rent-burdened reality. The current state of the American housing market is characterized by a profound and growing divergence between the cost of living and the ability of citizens to afford it. Since the turn of the millennium, the traditional relationship between income growth and housing costs has fundamentally collapsed. Data indicates that over 90% of Americans now reside in counties where median rents and house prices grew faster than median incomes between the years 2000 and 2020. This trend has created a structural imbalance that defines the modern economic experience for the majority of the population. Housing costs have become a predatory drain on the household budget, with nearly 46% of all renters in the United States currently classified as rent-burdened, meaning they spend more than 30% of their gross income on shelter. The implications of this burden extend far beyond simple accounting. When housing consumes such a massive portion of a family's income, it triggers a cascade of difficult trade-offs that impact health, education, and long-term stability. A cost-burdened renter in the United States typically has less than $10 in total savings, leaving them virtually zero margin for error in the event of a job loss, a medical emergency, or a vehicle breakdown. For a single parent earning a minimum wage, the math of the modern housing market is even more grim. After paying for rent and utilities, many are left with as little as $17 a day to cover every other necessity, from food and transportation to childcare. This environment of high costs and low affordability is further exacerbated by a chronic and worsening supply deficit. Despite a population that has nearly doubled since 1960, the number of new housing starts in the United States has remained stagnant, hovering around the same levels seen over 60 years ago. This has resulted in a national shortfall estimated at 4 million to 5 million housing units. In a functioning market, such a shortage would trigger a massive wave of construction, yet local regulations, restrictive zoning laws, and prohibitive development fees continue to act as a ceiling on supply. This supply constraint provides the leverage required for the hidden system to exert its control. Without the threat of new, cheaper housing entering the market, current owners and institutional managers are free to manipulate prices using tools that would be ineffective in a more competitive landscape. The modern situation is further complicated by the lock-in effect, produced by recent shifts in interest rates. Because a significant majority of current homeowners, nearly 69%, hold mortgages with rates at or below 5%, they are effectively incentivized to never sell. Moving to a new home would mean abandoning an ultra-low rate for a new loan at 6.5 or 7%, a transition that many find financially impossible. This has paralyzed the market for existing homes, forcing a record-breaking number of aspiring buyers back into the rental market, where they encounter the algorithmic pricing models that are currently the subject of federal investigation. Section 2. The construction of the modern mortgage. The hidden system that governs housing prices today did not emerge overnight. Its foundations were laid in the rubble of the Great Depression. Before the 1930s, the American mortgage market was a fragmented and highly risky landscape. Loans were typically short-term bullet contracts, lasting only 5 to 10 years, and required down payments as high as 50% of the home's value. When the banking system collapsed in the early 1930s, mass unemployment and plummeting home prices led to a foreclosure crisis of unprecedented proportions, threatening the social stability of the nation. In response, the administration of Franklin D. Roosevelt introduced a series of radical reforms that turned the American home into a state-sponsored financial project. The Homeowners Loan Corporation, HOLC, established in 1933, was tasked with rescuing homeowners by purchasing distressed mortgages and refinancing them into more stable structures. The HOLC's most lasting contribution was the standardization of the fully amortized loan, a mechanism where monthly payments reduced both the interest and the principal simultaneously over a 15-year period. This ensured that every payment increased the owner's equity, a concept that was foreign to the interest-only structures of the previous era. This evolution was pushed further with the creation of the Federal Housing Administration, FHA, in 1934. The FHA's primary innovation was the introduction of government-backed mortgage insurance, which protected lenders against default. By removing the risk from the banks, the government encouraged the industry to offer longer terms, eventually reaching the standard 30-year fixed-rate mortgage and lower down payments. This system was designed to prime the pump of the economy by fueling a construction boom, but it also created a permanent dependency between the financial sector and the housing market. What most people do not realize is that this system was intentionally designed to make housing an engine for national growth. By the late 1960s and early 1990s, policymakers expanded these programs to address rising inflation and wage stagnation. The government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac were placed at the center of a quasi-public market for mortgage-backed securities. This allowed capital to flow into housing at an unprecedented scale, effectively turning the American home into a credit card that citizens could borrow against to fund consumer spending and medical bills. This financialization of the housing market meant that the value of a home was no longer tied purely to its utility as a shelter, but to its performance as a financial asset within a global pool of capital. The final technological shift occurred in the mid-1990s with the rollout of automated underwriting systems. Freddie Mac's Loan Prospector and Fannie Mae's Desktop Underwriter replaced human loan officers with statistically informed algorithms. These systems were capable of processing complex rules in seconds, substantially raising borrowing capacity for millions of Americans. Research indicates that the shift to automated underwriting alone accounts for more than half of the house price growth observed between 1993 and 2002. By the time the 21st century began, the American housing market was no longer a collection of local exchanges. It was a high-speed, automated, and globalized system ready for its next phase of evolution, the era of algorithmic pricing. Section 3. The Financialization Pipeline. To understand how the system actually functions today, one must follow the path of a single dollar from a renter's pocket to the global financial markets. The modern housing system is no longer built on the relationship between a landlord and a tenant. It is built on a pipeline of financialization that connects local bedrooms to Wall Street balance sheets. At the heart of this pipeline are the institutional investors and private equity firms that recognized a fundamental shift in the American economy: the transition from a homeownership society to a rentership society. What this means in practice is that a massive portion of the residential inventory in the United States is now owned or managed by firms that view housing as a pure yield asset. These firms, such as Blackstone through its platform Tricon Residential, manage tens of thousands of homes across multiple states. While these institutional owners represent only a small fraction of the total national housing stock, approximately 0.5%, their influence is heavily concentrated in micromarkets, where they can exert significant pricing power. By controlling a large percentage of the available inventory in a specific suburb or city, these firms can set the market rate that all other owners then follow. The system is further stabilized by the use of complex financial instruments like credit default swaps, CDS, and total return swaps, TRS. These derivatives allow banks and investors to trade the risk of housing defaults and the total return of property portfolios without ever actually transferring ownership of the underlying homes. This creates a game theory environment where tactical smarts and financial engineering can generate massive profits from market disruptions. For the average renter or buyer, this means their monthly payment is being influenced by global speculators who may be betting against the very solvency of the housing market they inhabit. This is where things get interesting. The boundaries between these massive firms are often blurred. Financialized landlords are frequently entangled through joint ventures, partnerships, and minority stakes in each other's portfolios. This creates a network of interconnected interests that effectively discourages true competition. Instead of competing to offer the lowest rent to attract tenants, the heads in beds model, these firms have adopted a revenue management model derived from the airline industry. In this model, the goal is to optimize the total revenue across a portfolio, even if that means keeping certain units vacant to maintain high price points across the board. This coordinated business strategy is the engine of the modern housing crisis, and it is powered by a piece of software that most Americans have never heard of. Section 4. Algorithmic collusion. If the financialization pipeline is the skeleton of the system, then the algorithmic pricing software is its brain. For decades, landlords set rents by looking at what the person across the street was charging. This was an imprecise, human process that often left room for negotiation and competition. But in the early 2000s, a company called RealPage introduced a software suite that promised to eliminate the guessing game by using data to dictate the exact price of every lease. The mechanism is deceptively simple, but incredibly powerful. Landlords who subscribe to products like YieldStar or AIRM agree to share their non-public, competitively sensitive information with RealPage. This includes the exact prices of signed leases, actual occupancy rates, and renewal terms, data that is usually a closely guarded secret between a landlord and a tenant. The algorithm then aggregates this data from all competing landlords in a local market and uses it to suggest a unified price for all of them. In effect, the software allows competitors to coordinate their pricing without ever having to meet in person, creating what federal prosecutors have alleged is an unlawful price-fixing scheme. The impact on the consumer is immediate and expensive. A 2024 analysis by the White House Council of Economic Advisors found that renters in buildings covered by these algorithmic platforms pay more than $800 per year in additional rent, compared to those in buildings that do not use the software. But the system goes even deeper. RealPage also utilizes lease expiration management, a practice that aims to keep supply artificially low by sequencing when leases expire. By ensuring that there is never a glut of available apartments hitting the market at once, the software prevents the natural price drops that would occur during periods of high vacancy. This is the point where the system becomes truly predatory. RealPage's design is trying to persuade clients to take the recommendations by making it difficult for property managers to decline them. If a manager wants to offer a discount to a struggling tenant or lower the price to fill a vacant unit, they are required to provide specific business commentary and justify their decision to a RealPage pricing advisor. If the advisor disagrees, the decision is escalated to a regional manager, creating a professional environment where going against the algorithm is seen as a failure. This effectively removes the human element of empathy or local market knowledge from the pricing equation, replacing it with a cold, profit-maximizing logic that sees every tenant as a data point to be optimized. Section 5. From 2008 to the lock-in. The housing market has faced multiple crises that, instead of breaking the system, have served to strengthen its grip. The 2008 financial crash is the most famous example, where the securitization craze of the 1990s and early 2000s finally collapsed under the weight of unsustainable debt. In the years leading up to the crash, house prices had risen to unprecedented levels, fueled by a self-amplifying feedback loop of rising asset values and easy credit. When the bubble burst, it led to a near collapse of the global economy and a massive wave of foreclosures that left millions of American homes vacant. But what most people don't realize is that the 2008 crash was the catalyst for the next phase of the hidden system. Seeing an opportunity in the wreckage, private equity firms entered the residential market for the first time in history, buying up thousands of foreclosed single-family homes in bulk transactions. These firms transformed these homes into rental properties, professionalizing the management of the American suburb and setting the stage for the institutional control we see today. This transition turned the single-family home from a place of consumption with a little investment into a full-scale investment vehicle. The second major turning point occurred during the COVID-19 pandemic. A period of ultra-low interest rates and a sudden flight to the suburbs caused home prices to surge at a frenetic pace. Between mid-2021 and mid-2023, rent growth was so high that it virtually redefined the floor for housing costs in the United States. When the Federal Reserve began raising interest rates in 2022 to combat inflation, it created a new, paradoxical crisis: the lock-in effect. This lock-in effect has created a stiff penalty for anyone trying to stay in their home or enter the market. Because homeowners are locked into their 3% rates, the supply of existing homes for sale has plummeted by 32% since 2021. This has left the market in a holding pattern where prices remain high despite soft demand. It is a system in a state of contradiction, a recovery that doesn't feel like one, where more inventory is slowly hitting the market, but prices are in no danger of declining, according to industry experts. This paralysis ensures that the revenue management strategies of the large landlords remain effective, as there is no competitive exit for the average American family. Section 6. The Antitrust Reckoning. The hidden system finally met its most significant challenge on August 23, 2024, when the United States Department of Justice filed a landmark civil antitrust lawsuit against RealPage, Inc. The lawsuit, joined by 8 states including California, North Carolina, and Washington, alleges that RealPage violated the Sherman Act by enabling a pricing scheme that harms millions of American renters. The core of the DOJ's argument is that RealPage's software is not just a tool for efficiency, but a mechanism for algorithmic price fixing. The evidence presented in the case is striking. The DOJ alleges that competing landlords agreed to share their private data with RealPage specifically to eliminate the guessing game and take instructions on how to maximize rents. By using this data to train and run its algorithms, RealPage created a system where landlords would otherwise be competing on pricing, discounts, and lease terms, but were instead moving in lockstep. This digital cartel allowed landlords to maintain high prices even in markets that were downward trending, ensuring that the pain of the housing crisis was never felt by the owners, only by the tenants. The settlement reached in late 2025 forced RealPage to fundamentally alter its business practices. The company was barred from using active lease data to train its models, instead being forced to use aged data that is at least a year old. They were also prohibited from discussing pricing strategies in meetings with competing landlords and were forced to accept a court-appointed monitor to ensure compliance. While this is a massive victory for the DOJ, many experts argue that the damage to the market has already been done. The price discovery process has been permanently altered, and the massive data troves collected over decades remain in the hands of the very firms that use them to inflate the market. This legal battle has sent shockwaves through the industry. One major landlord with over 80,000 units has already entered a settlement to end the use of these algorithms entirely. However, the broader issue of the commodification of housing remains. When homes are treated as financial assets rather than places for people to live, the system will always find new ways to prioritize profit over people. The RealPage case is just one chapter in a much larger story of Americans fighting to reclaim their homes from the algorithms. Section 7. Modular revolutions and tax shifts. As the legal battle against algorithmic pricing continues, the search for a permanent solution to the housing crisis has led to 2 radical shifts. One in how we build homes, and one in how we tax the land they sit on. The traditional construction industry in the United States is notoriously slow, with stick-built single-family homes taking an average of 7.7 to 13.7 months to complete. This slow pace, combined with rising labor costs and supply chain disruptions, has made it impossible for the market to build its way out of the 5 million unit deficit. This is where things get interesting: modular construction. By building homes in a controlled factory environment and transporting them to a site for final assembly, companies like Mesocore and Triumph Modular are reducing construction times by up to 50%. Modular homes can be completed in as little as 3 to 4 months, often at a cost that is 10 to 20% lower than traditional methods. This speed to market is a critical tool for breaking the supply constraints that the hidden system relies on. If housing can be mass-produced with the efficiency of an automobile, the scarcity leverage held by large landlords begins to evaporate. Parallel to the modular revolution is a growing movement for land value tax, LVT. Rooted in the economic theories of Henry George, The LVT argues that the current property tax system is actually designed to punish housing development. If a property owner builds a high-density apartment complex on a vacant lot, their property taxes skyrocket. This incentivizes land speculators to keep land vacant or underutilized while they wait for prices to appreciate, a practice known as holding for speculation. A land value tax shifts the burden entirely onto the value of the land itself, regardless of what is built on it. This creates a uniform pressure in favor of development. If the owner of a parking lot in a downtown area is taxed as if it were an apartment building, they have every incentive to either build the apartment building or sell the land to someone who will. This value capture mechanism discourages the hoarding of land and forces a massive increase in housing supply in the areas where people want to live most. While still politically controversial, the LVT is increasingly seen as the perfect tax to dismantle the structural inequality of the housing market. The future of American housing will be defined by the collision of these two forces: the corporate hidden system of financialization and the rising market-based movement for rapid supply and tax reform. In Congress, bills like the 21st Century Road to Housing Act aim to ban large investors from buying more homes, signaling a bipartisan appetite for radical intervention. Whether these efforts will be enough to restore the American dream remains to be seen, but the era of the secret housing algorithm is officially coming to an end. Ending. The philosophical question. The hidden system that controls housing prices in America is more than just a collection of software and spreadsheets. It is a reflection of what we, as a society, have chosen to value. For nearly a century, we have constructed an economy where the home is the primary vehicle for wealth, leading to a world where middle-class Americans have treated their houses like cocaine, borrowing against them until they are hollowed out by debt. We have allowed the invisible hand of the market to be replaced by the digital hand of the algorithm, and in doing so, we have turned a basic human right into a high-frequency financial play. What the data and the lawsuits have revealed is that the housing crisis is not a natural disaster. It is a choice. It is the result of laws that allow corporate landlords to coordinate prices, tax codes that reward speculation, and a financial system that prioritizes yield over the stability of families. The struggle of the 40-year-old first-time buyer and the 17-a-day single mother is the toxic stress that keeps the gears of this system turning. As we look toward a future of modular cities and restructured tax codes, we must ask ourselves a deeper question. If the current system is designed to maximize the price of the most essential thing we need to survive, then what is the ultimate goal of our economy? Is the purpose of the American home to provide a foundation for a life, or is it simply to serve as a line item on a Wall Street balance sheet? The answer we choose will determine not just the price of our houses, but the character of our nation for the next 100 years.